Good afternoon. Hey guys, can you give me some noise? I know it's late. Can you give me some noise? Thank you. Thank you. Thank you. How many of you guys traveled to Cannes for this conference? Can you raise your hands? Wow, everyone. That's crazy. Where you guys from? Germany. Nice. I heard the guys are cute there. Where else? Also, no, everyone is German. Great. Awesome. So today I wanted to talk about high frequency trading at this Ethereum conference. I know most people, they build Ethereum applications, they use smart contract, but this is really a topic that I relate to myself the most, and I wanted to share how I got into high frequency trading, how I was able to kind of move around and find profitable opportunities, and if there's anything that you can take away from this talk and do it yourself, I'm more than happy to help you guide through that as well. I think the space will only flourish if we all work hard together, and it's not a zero-sum space for sure. And with that said, I'll start my talk today by asking how many of you guys have traded cryptocurrencies? If you can raise your hand. Wow, almost everybody. Great. And then of the people raise your hands, how many of you have made profits by trading? Okay, a little less, but still, I've seen some winners here. That's good. And do you use more centralized exchange or decentralized exchange? If it's centralized, then can you raise your hand? Oh, wow. So we have a lot of DEX users here. How many use DEXs? Wow, we have more DEX users than centralized exchanges. That's amazing. When I first got into crypto, there were no DEXs that was available to use except for maybe Uniswap or some ones on Solana, but more like AMM versus a centralized order book. And so I got into the space by at first just mining Dogecoin, and to this day, it's still on my laptop here, the Doge. This was 2014. That's how I kind of got really interested in crypto. And I got my first job out of grad school at Pantera doing quant research. And then after that, I kind of just started doing that myself. Wait, I think the connectivity problem. It's very common in crypto. So today I want to first give a high-level idea of why crypto is still big and what are people doing these days, because I think arguably we're in a bear market-ish right now, but there's actually a lot of institutional interest around crypto as an asset class, and that has never changed because of a lot of reasons. A lot of institutions like traditional financial institutions, ETFs, hedge funds, mansions, mutual funds, they can't get easy access to crypto. So I think we're really entering this institutional era, not because I said so, but based on the numbers. So I think to figure out how to, thrive in the next crypto markets, I think it's really important to understand what institutions are doing and how that kind of wave is moving towards. And in today, we've done a broad kind of research. There's probably overall family offices are allocating at least a little bit into cryptocurrencies. And how they do that is not through necessarily, just register on Coinbase and buy a bunch of Bitcoin and Ethereum and just sit it there. They have a lot of compliance and regulatory mandate. So oftentimes for example, they can come to us or they go to some other custody vendors like Bitwise or whatnot, and then they buy products that give them exposure to crypto. And there's different products, right? We're all familiar with Bitcoin, Ethereum, and the difference between Bitcoin and Ethereum is Bitcoin is more like it's more like an asset. It's more like gold. Whereas Ethereum, it's everything, right? Ethereum is smart contract. It's an asset, right? It's something you can build it with, and then it's just like it's everything combined together. So that when people predict like Ethereum's price is very different from Bitcoin. Bitcoin is more supply and demand, whereas Ethereum, there's a lot more indicators that go into predicting the price. So about myself, I'm CEO and founder of Icon Trading. We're a systematic trading firm that specializes in cryptocurrencies. Right now, we mostly do high frequency and mid frequency strategies. The difference between them is high frequency strategies is more like market making, and then you move within seconds, or you're competing on the speed essentially. So on the high frequency side, the competition is pretty fierce. I would say it's like, Jane Street. Actually, Jane Street don't do that much high frequency in crypto, but like Jump, Wintermute, are some examples that can compete really, really well on the speed. And mid frequency wise, it's always really fun. I'm sure you guys have heard of a lot of trading algorithms like mean reversion or can you name another like things that you have tried before mid frequency, like stat arb, momentum. It's one of the French words I picked up. And I think here what I really wanted to kind of talk about here is like, what can you take away from this talk? And I want to give you a kind of detailed kind of breakdown of what quant is. Because many people are curious about quant trading. Many people are curious about like algorithmic trading and portfolio like hedging, etc. Because crypto, when it's going up by a lot, but when it's going down, you could lose like 50% in a day, and that's not what we want. So the mystery around like quantitative strategies is that we give the decision to algorithms and machines so that we don't make emotional decisions about our positions. So for example, if Bitcoin is, for example, if Ethereum is going from 2,000 to 3,000, and you're like, oh wow, this is a great day, I'm on the top of the world, and then the next day goes down to 1,900, and you're like, oh man, like I wish I had sold at 3,000 versus hold it still, and now it's at 1,800 or 1,900. And the way to do it is very simple with quant and algorithm trading, is that you have an idea. Everything starts with an idea. Your idea is how does your program work? How does your algorithm work? And what are your trading ideas? For example, you can say, hey, what about if Ethereum hits 1,800, I'm going to buy no matter what. And then if it hits 2,500, I'm going to sell everything. What if it's just like as simple as that? That's called great trading, which is a very common thing that people do. The benefit of that is that you're capturing your winning, right? You're capture your winning and you're selling at the approximately the right time. Whereas, but however, you could also miss out on the upside. What if it after 2,500 it goes to 4,000, then you're effectively losing out on that 1,500 gap. But what you think to yourself is like, okay, I'm just gonna stop my wins and leave it like that. And that's totally possible. Another thing sometimes could happen is that you could also get liquidated when you use perpetuals. And with trading spot, you might end up paying like good amount of fees if you're not a higher tier like trader or market maker. So I think the lesson here is that you can always backtest your strategies. And I think the best way to start running these strategies, especially with AI now, I would say that in the past, it takes a lot of effort to be a quant, to learn Python, to write algorithms in a way that's very robust. But nowadays, you can honestly just go to cloud and be like, hey, I want to write a momentum strategy. Can you write one for me in Python? And then you can run those bots on your MacBook or whatever computers. And the problem with that is that I don't think anyone should trust a bot or AI with real money, because I've done it, and it's honestly not the most fun, because when it's making money you feel great, but when it's losing money you're like, oh my god, this bot is literally like squandering my savings, and I don't want that. And that's totally fine. I think just with a lot of the other like trading strategies, it's a never-ending journey, meaning that you can have good days and you have bad days, but it's very important to always stay. Well, this is proprietary. I don't know why my team put this slide on. This is very proprietary information, but I'll share with you guys. What we do, and like what's kind of takeaway here, is that there is a high frequency arbitrage. You can do BTC and Ethereum. You can arb them. You can also try pairs trading. I'll mention a lot of words that may seem like very foreign to you, but you can just ask ChatGPT, and it's like pretty straightforward to kind of figure out like what they actually do. And I will provide liquidity for some of the tokens. Regime adaptive, trying to carry. So this is more like momentum, and with regime in crypto specifically, there's different types of regimes. Some regimes are like, I'm sure you guys have all heard of the 4-year crypto cycle. And now it's not as true anymore. I think the cycle has actually been less volatile and more shorter in the same time, versus like before. I think things move in a slower pace, but in the same time more drastic, because you have less players in the space. These days, I think because of a lot of it's becoming more institutional, so the players are less driven by the sentiments on Twitter, or how retail like rally around like certain topics, right? There's the meme coins, and then there was the NFTs, and then there was what was it before? ICOs, and then NFTs, and then we had the meme coins, and each of those like lower liquidity tokens are more driven by I would say like the kind of sentiment or retail, whereas because the capital pool is much smaller, whereas assets like Ethereum and Bitcoin, it's not really driven by retail. I know we all have a Twitter account, and we go on Twitter, we look at the sentiments, we're like, oh, crypto is going up, oh, let's buy more. We might think that it's driven by those kind of sentiments on social media, but it's actually not, because those flows are very tiny compared to the rest of the market makers, the systematic traders, etc. I'll pause here for a couple questions. Do you guys have any questions so far? No questions. No one's, you.
What's high frequency trading in terms of time for you? In sense, what are actually timelines when it comes to high frequency trading, as you call it in your case? Because in regular financial markets, it's sub-second. Then you have to use custom built hardware and FPGAs and stuff like this to support it. In crypto, we have finality in both cases, BTC and Ethereum. So I don't see any need for sub-second trading in that sense to be called high-frequency trading.
Yeah, that's a great question. So with TradFi, the bar is actually higher for participants, and therefore you end up with like giant institutions that they compete on the milliseconds, like the super high frequency, because the infrastructure is also a lot more mature comparing to crypto. And so with TradFi, traditional financial industry, the high frequency, in my opinion, is actually higher frequency than the high frequency in crypto. Because in crypto, anyone can set up an exchange account, write some algorithm, and just start trading, right? So the bar is a lot lower because everyone can participate. And in the same time, how I usually define it is mid-frequency would be more like, say, like 20 minutes to an hour, or maybe even yeah, 20 minutes to an hour, maybe a few hours, like in that range, I would like intraday, I would call it mid frequency. And then I think anything faster than that, say like within 15 minutes, 15 minutes and 5 minutes are like common kind of time frames that you can use to predict the prices. I think within that, I think is more higher frequency, but the absolute high frequency, if you're talking about like market making and you're eating the spreads and you're figuring out whatever ways to compete on the order flow, that's like true high frequency. So what I like to think is like, ultimately the goal is to be profitable. And in order to be profitable, there's many ways you can compete. Compete on high frequency and the infrastructure is definitely one way to do it. I don't know if that answers your question, but that's, in my opinion, how I define high frequency. Awesome. Thank you for the question. Yeah, you.
How important is MEV and these kind of topics in execution of these high frequency trading things?
That's a great question. So I actually just ran into a high frequency guy outside, and I've tried MEV on Ethereum and Solana as well. The beauty of MEV is that it's like if you are able to sandwich an order, you can make a lot of money. And in the same time, it's not a guaranteed kind of like win rate at each time. And the competition is pretty fierce also. You're competing on the infrastructure because to do MEV, in my opinion, you need to have like pretty good-ish infrastructure and understand like how different protocols work. This also brings up to the topic of like on-chain versus off-chain, right? Centralized exchanges trading is all like off-chain. So we're competing on like, can you predict prices better versus like on-chain MEV? We have a lot of like independent searchers, right? You don't need any capital to do MEV searching and to like sandwich attack, etc. You don't need that much money. You need some, but not a lot. I think MEV is really important. It's basically the same role as us market makers on centralized exchanges because it's making the market more efficient. And yes, they're making money by doing so because otherwise they won't do it. But because MEV exists, and all these like searchers are profitable, they're able to make a living. I think it's actually providing a lot more liquidity and make the market more smooth, and make the price. It's like discovering the price, right? And it's if the on-chain prices and off-chain prices are very different, and then someone would arbit because there's profits. So wherever there's profits, there are people doing it to make the market more efficient. So they're really important. They're like market makers on-chain, basically.
You said earlier that Bitcoin does follow gold. Do you really think that Bitcoin is really a store of value? Because recently, I mean, it didn't behave like a store of value. It did behave more like a security asset.
Security asset, I think. So we're in Europe right now, right? So the regulatory body in Europe is MiCA, I believe. And that's different from the regulatory bodies in the US. The US are CMTC and OFAC for money laundering and SEC for securities. So Bitcoin, Ethereum, in my opinion, especially in the US, it has already been defined as not security by the regulatory bodies, even though it's it's still unclear who actually governs crypto inside of the US. They're still fighting over it because it's a big pie. It's a lot of money. So everyone wants to be the one that's like, oh no, the CFTC be like, no, we're the one governing crypto. And SEC be like, no, they're all securities. Like we're the one governing crypto. And then they can like send letters to all these different protocols or perp dexes or whoever they want for a letter of like, hey, you're doing something illegal, and they have to like pay the SEC or whatever. It's I don't know if I'm allowed to say it, but it's pretty corrupt. But going back to the security question with Bitcoin versus Ethereum, I think with Bitcoin, the interesting thing is that so the definition of security is that it has to give profits back to the holders, right? It's revenue sharing and it's giving yields and dividends, etc. And Bitcoin clearly is not doing that. So I don't think Bitcoin is security from my definition personally. And Ethereum's the same way. I don't think you can get, yes, there's there's the halving happen with Bitcoin and the proof of stake happening with Ethereum, but it's not really by holding Ethereum I get to like profit share, quote unquote. And I think Bitcoin to a large extent it has become both like a combination of different things as well, not just as a star value, right? It's easy to look at an asset when the price is going up. You're like, oh, this is storage of value. But when the price is going down, you're like, no, you're not a storage of value anymore. I don't think that's a fair statement because all assets, including Bitcoin, it will go up and will go down. And with other like securities or stocks, there's maybe more reasons that people could attribute to the price movements, right? Like Figma, right? For example, that company, you can look at the earnings report and be like, okay, this company is worth XYZ because it's making XYZ in profits. You can't do the same with Bitcoin. But I would also argue that you can't do this with a lot of companies in general. Like a lot of companies like Uber is still losing money, but it's a multi-billion-dollar company, and then people don't buy and sell Uber stock based on how much money has made or lost. So I think like when it comes to assets and its prices and how you discover the fair market value of an asset, it's really not based on is it generating revenue or is it sometimes it could be like everybody's talking about something and the price of that asset goes up, right? Because it's a attention game. If you pay attention to something and then the value goes up. And sometimes it could be about speculation because other people think the price is going to go up. So yeah, and then you buy something. That's also the story of many luxury items and I think many cryptocurrencies as well, right? It's like purely speculation and there's no intrinsic value of that token. How many minutes do we have left? Oh, it's over. Okay, one last. Wow, I'm glad. This is a team. If you're curious, all right, this is the Q&A slide. This is my Twitter and my email if you want to reach me. One last question before we wrap up the session. All right, you. Wow, you have so much hair.
Thank you.
That's not.
I said thank you for the mic,
I
not
wish
for
I
the
have this much hair.
Yeah, I want to ask, as a market maker, how much does the on-chain reality affect your strategies? Are you purely based on data you observe off-chain on the order books, or do you also observe
on-chain data? Yes, that's a very good question. So for high-frequency stuff, none of the on-chain data matters. But for mid-frequency and lower, on-chain data matters. That's a short answer to this question because there are many data vendors in crypto, right? Their business model is that they sell data to institutions and then they make money because they made the sell. And a lot of those on-chain data are not true, right? They're not real data. There could be a lot of latencies. It could be like just not accurate. They could even make up some data and sell it to you. Or they can like summarize different features and be like package it as a new like indicator. Be like, oh, we're selling you this new on-chain data that you can purchase and you can subscribe to us for like $100 a month. I think that was a good business like before. I think if someone's trying to sell you data for XYZ dollars, you should also always be suspicious because they, first of all, may not have the best data. Second of all, if the data is so good, they would just trade on that data themselves. Why would they sell it to you? So that's the thing with trading. It's like always very obscure, right? Like if you're so good, why are you selling the data? So always be very cautious if someone's like trying to sell you on-chain data. But I do think if you find a good vendor, it's helpful for like more mid-frequency, if you want to trade like a couple times a day, or maybe look at the general trends and make decisions that way, I think that's really helpful as well. So yeah. Thank you. Thank you. I wish you guys having a great conference at ECC, and it's always great to come to South of France.